If you are still using just candlestick charts to trade, you are missing out. I would highly suggest using something called footprint charts. Footprint charts are one of the tools used in the type of trading strategy known as order flow trading. Now, just a few years ago, these tools were only exclusively available to the big hedge funds and big banks, but today, just about any serious trader has access to them. Now, if you learn how to use the footprint charts, you will be able to see all the important data and information that the candlesticks will not show you. You will be able to watch all the buy orders and sell orders as they come in real time, and that can help you to determine who is control of the business, the buyers and the sellers, so that you can ride with them to some profit. Now, what I want to do in this video is I want to show you how to read the clues on the footprint charts and how to use those clues to determine big price move even before they happen. My name is Sam. Let's dive into it. Now, the footprint charts, like I initially mentioned, is a trading tool used in order flow trading. Now, before I go ahead and talk about them in details, I would love you to understand, first of all, what order flow trading is. Now, order flow trading, simply put, is a trading strategy that allows you to observe the interactions between the buyers and the sellers to determine who is controlling price. Now the traders who do this type of trading are looking at stuff like who is buying, who is selling, how many assets and at what price. So what they are trying to do is they are trying to spot patterns in the chaos of orders that are coming in real time. So the whole essence of order flow trading is that if you are able to determine precisely what the big traders are doing, or if you are able to determine where the majority of the trades are, whether on the buy side or on the sell side, if you have that information precisely, you can be able to capitalize in that and ride with them to some profit. It will be just like swimming with the tide or riding the wave. Okay? But when we look at it, you will find out that that's just the whole essence of trading. But the problem with traders that are only using candlesticks is that the candlesticks are not able to precisely show you on which side are determinant in the market forces. So what it means that they cannot show you which side are dominating, whether the buyers or the sellers. And the only tools that I know that can do that precisely are the footprint charts and order flow trading tools in general. Now, having said that, there's another important thing that I would like to get out of the way before we proceed. And that is the fact that you need to be aware that the footprint charts and order flow trading in general are not the holy grail in trading. Okay? There is no holy grail in trading. But order flow trading is better than almost all the strategies I have seen out there. Okay? The chart patterns, market cycle, indicators, you name it. And by the way, I hope you know that almost all the indicators are lagging. Okay? Almost 100% of the indicators out there are lagging. What they actually do is follow price, and that's just the difference between them and order flow, because order flow itself occurs in real time. All right, so order flow will give you an edge and will let you see what is hidden behind the candlesticks. Now, I want us to look at some of the tools of the order flow trading. And guys, please, I need you to be attentive here, because if you are able to understand the workings of these tools, it will greatly help you to be able to analyze the market in real time. One of the most effective order flow trading tools that I want to quickly talk about today is the volume profile. The volume profile is kind of different from the normal vertical volume bars. You know, the vertical volume bars that are usually placed under a chart. Why those vertical volume bars show the total volume per time period? This horizontal volume profile shows volume distribution by price. So as you can see, this shows the distribution by price. So what it basically shows you is where most of the trading action is happening at different price levels. Okay, now taking a look at this 4 hour time frame from trading view, you can see little bumps sticking out here. You can see all these little bumps sticking out here. These are called high value areas. It just tells us that this is where the highest number of volume is at. You can see there are a lot of green and red candles around this area. So they are indicating that a lot of buying and selling is going on around here. Think of these high value areas like these intersections in the road. Right things to slow down in these areas and also be aware of that, please. Prices tends to slow down here, and that is because, like I said, a lot of buyers and sellers are battling out at this area. Now, our jobs as traders is to find imbalances in any market using these tools. No, I'm sorry, guys. I should have talked about balance and imbalance market before, but don't worry, I'm going to talk about them in a minute. So, as I was saying, this big spike right here, this is known as the point of control. This is where a lot of orders are sitting, and because there are so many buy and sell orders right here, it acts as a significant support and resistance level depending on the direction of the price. Please be aware of that. So what it means is that a lot of institutional traders will use this as support and resistance level. And you as a retail trader should be aware of that when approaching this level. Okay? So this thin area right here, there's another one right here. These are called low value areas. It is like a gap in the market where there's not much buyers and sellers. So you should be aware when, for instance, if price is breaking out of this thin area and then you look by the side and see it is a thin area, it could actually be a fake out. It will actually be a fake out, and what it means is that price will almost certainly reverse immediately even after breaking out. So please be aware of that. But even at that, as a rule of thumb, you shouldn't even trade if there isn't any much volume in the market. You should only trade when you see enough volume in the market, like you see in this area. It is an indication that it's a healthy market and there's healthy volume. A lot of buyers and sellers will be sitting around here. So guys, I think that volume profile is very important as a trader because it can help you to spot a significant support and resistance level. So I think you should consider incorporating it to your trade, as it can help you to spot fake out and avoid common pitfalls in trading. I want to briefly talk about limit order and market order because understanding them will have a bearing in this whole thing we're discussing today. Now, what is a limit order? A limit order is simply an instruction to buy or sell a financial asset at a specific price or better. With this, you are basically telling the market the price level you wish to buy or sell an asset or a stock or a crypto coin, forex pay, whatever the security may be. You are only willing to buy at your desired price or lesser. Or if you are on the sell side, that is sell limit order. You are only willing to sell your asset at a specific price or higher. Now, let us use an analogy of a watermelon to explain it for easy understanding. Imagine you are at a farmer's market and you really want to buy a watermelon. But here's the thing, you are not willing to pay more than, say, $5. You are not willing to pay more than $5 for the watermelon.
Obviously, I don't know how much watermelons are sold, but for the purpose of this example, you are not willing to pay $5 for them. Now that's your limit. So what do? You tell the vendor, hey, I'll buy a watermelon, but only if it is $5 or less. That's basically what a limit order is in trading. You are saying to the market, I'll buy this stock or this crypto or this forex pair, but only if the price drops to $50 or $30 or $20, whatever your price limit is. You are not rushing in to buy at whatever the current price is. You are setting your limit and waiting for the market to come to you. And just like at the farmer's shop or the farmer's market, your order sits there waiting. Maybe the watermelons are selling for $7 right now. Your order is just chilling, waiting for the price to drop. If you never hit $5, well, you don't get your watermelon. But if the price drops to like $5 or below, you've got yourself a treat. In this case, a watermelon. So that's what a limit order is in a nutshell. You are setting your price and letting the market come to you instead of just taking whatever price is out there right now. Now, there is a buy limit order and there is a sell limit order. And traders who place limit orders are sometimes referred to as passive buyers or passive sellers, as the case may be. So that is what limit order is. But market order, my handwriting is not is not that organized, guys. So bear with me. So market order. A market order, on the other hand, is an instruction to buy or sell a financial asset immediately at the best available price in the market. Now, this type of order characterizes execution speed over price, meaning that market orders are often used when immediate execution is more important than obtaining a specific price. Now, if you're using market order, it means you do not care how high the price is. You just want to have the stock or the crypto right away. You are dying to have the watermelons right away if we are to go by our example. You don't care that price of those watermelons is $7 or maybe it has risen to $10 even. You just want it right away. With market order, you are guaranteed to make a trade right away. Your order is filled immediately. There is no traffic, you know, because you just want to get your price. You don't care how much it is. Your order is guaranteed to be filled immediately. So traders who make this type of trade are sometimes referred to as aggressive buyers or sellers. And just like in the case of limit order, there is buy market order and sell market order. Now, you have to understand that the financial market operates in what is known as the auction market theory. This is just similar to the auction you see bankers do when there's a foreclosure, for example. You see people buying at an auction, and when you see them buying at an auction, the price will go up if there are more people willing to buy than sell, and the price will come down if more people are willing to sell than buy. Now, this is just common economic theory of demand and supply. So it's kind of like that in the financial markets too. It's the same idea. The price of stock or crypto will go up if more people are willing to buy than sell, and it will go down if more people want to sell than buy. So it is this disagreement on what prices should be that pushes prices to either go up or go down. The buyers and sellers cannot agree on what the fair price of watermelons should be, pushing prices up or down. Now, the reason I say that it is disagreement between the buyers and the sellers that pushes prices up or down is because in the financial market, it operates in what is known as the balanced and imbalanced market, right? First of all, what is a balanced market? A balanced market is a scenario where demand and supply are in equilibrium, meaning that there is an equal interest from buyers and sellers, right? So, in this scenario, the supply of watermelons, for example, or the crypto or the stock is great, right? There is enough supply, and both the buyers and the sellers believe and agree that the price is fair. Now, the price is only based on their perception for whatever reason. But because the price is perceived by all the parties to be fair, it results in a situation where neither the buyers nor the sellers dominate. Now, this results to the market being calm, there is no excitement, and if you look at the charts, you will see that price is moving sideways or within a range. But then the market is not going to stay there forever. And usually, the reason for that is that new information about the asset or the market or the economy in general, there's always new information. New information always comes in every day of trading, basically. And when traders hear this news, all of a sudden, there is a disagreement between the buyers and the sellers on what the fair price should be. It's like suddenly everyone at the farmers market heard that watermelons are going to be scarce next week, and almost immediately, buyers start offering higher prices and sellers hold on to their watermelons, and this results in price starting to trend up. Now, in contrast, if the news is about maybe, let's say, if the news is if the news is about the government planning to bring in large consignments of watermelons next week, for example, the sellers will suddenly reduce their prices, and the buyers will offer lesser and lesser prices, and price will obviously downtrend. Now, this scenario that I just described is known as imbalanced market. This is obviously a situation where one or two groups of traders, and in this case, the buyers or sellers, one group is dominating the market at the moment. You know, when one group is dominating the market at any moment, it is called an imbalanced market. And you, as a trader, what you should do is that you should obviously look to see who is dominating the market and then join that group of people that are dominating, whether the buyers or the sellers, anyone that is dominating, just join them. That is the whole essence of trading. But this imbalance that I just talked about, the imbalance will not continue either up or down. It will not continue forever. You know, it will get to a point where it loses its steam and the market will balance out again. What it means is that when it loses its steam, the buyers and the sellers again agree on what a fair price should be, right? Now, I hope you understand this concept that I'm explaining to you, because this is exactly how the market works. And this, like obviously, as you can see, the market is a constant oscillation between a balanced and imbalanced market. So your job as a trader is to spot the imbalances, because, like I said, that's where the big money is. If you can spot the imbalance before it happens, you will certainly be in profit. And the best way I know to clearly spot these imbalances is by order flow trading, using order book and footprint charts. And that's what I want to talk about next. So, here is a normal candlestick chart, and by the right is a screenshot of a footprint chart. So let me expand it a little so that you can be able to see what I'm showing you. Let me expand it just a little. Yes, that is a footprint chart. A footprint chart as an order flow trading tool enables you to see behind what is hidden from you if you are looking at just the candlestick. For example, you cannot spot the imbalanced market that we were talking about before when it is building up at the early stage if you are depending on candlestick patterns or indicators, you know. So, but in order for you to easily understand the working principles of the footprint chart, I think we should first try to understand another book function before we can get back to the footprint chart. Okay, so let's take a look at another book first before coming back to. Now, here's another book that I got from Bybit. Okay, another book is a real-time buy and sell order list for a particular asset. Now, this particular order book records the transactions on the crypto coin Solana. But don't worry, it is the same principle in stock, in forex, and other markets. Other books have the same working principle. Now, so this is another trading tool, just like the volume profile we talked about earlier, and also the footprint chart that I'll talk about soon. All right. Now, in its simplest form, another book will have the bid. The bid. Now, the bids are the different prices that buyers are offering to buy the asset. Okay, these are the bids in this particular order book. These bids are the ones in green. Okay, now these prices will be lower than the current price of the asset. They are normally lower than the current price of the asset. Now, at the time I did this screenshot, the price of Solana was 138.75. That is why I put it here. So as you can see, um, the highest the highest bid that has been put in is actually lower than this. These guys, I need you to pay attention to what I'm saying here. Okay. Now, the other book will have the other section of the other book is the acts. The acts. The acts is basically the price is demanded by different sellers that are offering the assets for sale. This is the acts list here. The ones listed in red color. These are the acts. Okay? And now this acts normally will be higher than the current price. As you can see, 138.79 is actually higher than 138.75, which is the current price. All right? Now, both the bid and the ask will also have the sizes of the asset being offered for buying or selling. Okay? These are the sizes that the bidders want to buy. These are the sizes listed according to the price level that the bidders are offering to buy. All right? And these are the sizes that the sellers want to sell. These are the sizes listed on this side of the order book. But please be aware, guys, that the orders that are listed on the order book are only limit orders only. Yes, limit orders are the ones listed on order book. And I believe you remember what limit orders are. In our example, limit orders are those looking to buy watermelons when the prices come to their desired level. So please bear that in mind because the opposite applies in the footprint chart that we'll talk about in a minute. All right. Okay. Now, the highest bidding price is listed at the top of the bid column. Here it is. This is the highest bidding price. If you are a seller, this is the best price that is being offered to buy your asset. 138.72. That's the highest you see. And it keeps on going down as you go down the list. The prices reduce as you go down the list. All right. Now, the opposite applies in the other side. That is the ask price. Because it is actually the lowest in the ask that is listed at the top. Right here. Okay? If you are a buyer, this is the best price that you are looking at. That's the cheapest that has been offered. Okay? So that is what it is. Okay? The bidders in the bidding side, the highest price is listed at the top, and in the asking price, the lowest price is actually listed at the top. So the difference, there is something called spread, and spread is actually the difference between this and this, between this highest bid and this lowest spread and this lowest ask. This is called a spread at this level. Understand? So what it means is that if you subtract this one from this one, what you get becomes the spread. And the spread is just one of the expenses that you make to get your trade executed. Right? Okay. Now, like I said, the price of the asset at the time I did this screenshot was 138.75. All right. And at this bid side, okay, at this bid side, some traders are actually putting in a bid to buy 37.205 of the asset. And what they are basically saying is, we are willing to buy the asset, in this case Solana or stock or watermelons or whatever. What they are saying that we are willing to buy the asset at 138.72 or lower. And this is the quantity we want to buy. Here is the quantity. This is the quantity we want to buy at this particular price. That is basically what they are saying. But when you look at the ask price, the closest price to that the sellers are willing to sell is actually 138.79. And the quantity, that is the size that they are being put out for sale, is actually 22.623 of the assets. So what it actually means is that these orders are not going to execute until the prices hit their target. Now, if you look further down below, like, okay, let's use it as an example, this level, the bidders put in, I hope you can see this very well. The bidders put in put in a bid to buy 103.823 size. This is the size. They want to buy the quantity of 103.823 at this price, and the price they are putting in for this bid is 138.69. This is how the order flow works. It's just a very simple something, and basically is that the summary of it is that if the bid price matches the ask price, then a trade will be executed. If somehow this one matches this one, a trade will be executed. That's just the way it works. As simple as that. But guys, remember that the order book is constantly changing as trades happen within the seconds, because new orders are constantly coming in. And using this tool actually can help you see clearly who amongst the buyers and the sellers are dominating the market at any point in time, which is of course imbalance that we're looking for.
Now, if you understand the workings of the order book, it will greatly help you to be able to spot where support and resistance might be. But you have to be aware that it is not 100% guaranteed. The reason it's not 100% guaranteed is that you know that the order book records only limit orders. All right. And limit orders, from our example, if you remember, is put in by traders that want to buy the watermelons only if the price drops. Okay, that's for the buy limit order. Or the traders that want to sell their watermelons only if the price rises. That is for the sell limit orders. And common sense will tell us that in such a scenario, such a trader can go back and cancel his order, okay, for whatever reason. And as a matter of fact, traders cancel their orders all the time. That is why you cannot rely 100% on the data that you are seeing in the order book. Okay, it has been reported several times in the media, as a matter of fact, that there are some big hedge funds, some big manipulative hedge funds involved in a kind of scam. And what they do is actually they use limit orders to perpetrate such acts. What they do is they put in limit orders, sell limit orders in their billions. Okay, once they're interested in an asset and they feel that the price is too high, they put in sell limit orders in their billions. And you, as a retail trader, once you see such an order, you get scared. Okay, they scare you into selling your assets. And once you sell your assets, they later go back to cancel their orders and then buy the assets cheaply. It's a common scam, and it has been reported several times. It's known as, I think, spoken attack. Okay, so that is why you cannot rely 100% on the data coming out of the order book. And that is a major difference between the order book and the footprint chart that we are going to talk about in detail soon. Okay, because while the order book records limit orders, the footprint chart records market orders. All right, and from our example, the market order is put in by a trader that wants to buy or sell the watermelons immediately, regardless of the price. Those kind of traders are known as aggressive buyers or aggressive sellers. Understand? And as soon as their orders are executed, it goes straight into the footprint chart in real time. All right. Now, a normal candlestick will show you the opening price. Yeah. Okay. The closing price, the high, and the low. I'm sorry, I didn't get the right screenshot for this candlestick. Okay. So, but that's just what the candlestick will show you. But the footprint chart shows you all of those as well as others put in by traders at different price levels, which of course actually shapes the candlestick itself. Okay. Now, these numbers that you see here, all these numbers that you see here and over here, are market orders sent to the market by traders at different price levels. I'm sure by now you know that market order is the order sent in by traders that are buying watermelons immediately. So the footprint chart actually records orders that are already executed in real time. All right. So, like this price level, for example, you can see that at this price level, 65 market orders have been executed here. All right. Same as you can see that 416 orders are done here and 177 orders are executed at this level. So these numbers represent the volume of orders filled at each price level. Now, on the left side here, this list, on the left side down,
are market orders that hit the bid. Now, please, I need you to pay attention to what I'm about to say here. Okay? The left side are market orders that hit the bid. But because these are aggressive orders, that is, market orders of people that want to buy immediately, these bid side are actually sellers. Here, this side are the sellers. All right? Now, I know that you may be wondering why the bid side are now the sellers when in other book, the bid sides are the buyers offering to buy. Now, the difference, the reason for that obvious contradiction is that in the other book, the bid side represents the standing by orders. These are orders that are not yet executed. They only reflect buyer intent, right? But on the footprint chart here, the left side shows trades that already occurred at the bid price. In other words, the trades are seller initiated. Aggressive selling, it is the seller who initiated the trade, right? It is the seller who initiated and also willing to accept the price. So it is not the buyer that is putting an intention to buy. Okay? So that is why I said this bid side in the footprint represents the sellers, unlike in the other book. Okay? So I really hope you understand exactly what I'm trying to explain to you here, okay? But in case if you do not have if you still have some confusions about it, or if you have any questions about it, please be sure to let me know in the comment section. So here all right, you can see 712 orders are placed at this level, 777 orders placed here. So these are all sell orders that hit on the bid. Now, these ones right here on the right side are market orders, okay, on the axe, which are the buyers. Sorry, hold on. These are the buyers aggressively buying at different price levels. So, as you can see, each footprint chart that you see is telling its own story within each candle, as buyers and sellers battle it out for which group is going to control price. Now, your job as always is to have a keen eye on these two. Okay? You need to have a keen eye on these two so that you can be able to identify which group between the buyers and the sellers who is more aggressive with their trades, and then you can ride with them to sub profit. So it is just like peeling back the layers of what's really going on in the market. Okay? This platform is from a trading light, and here is a live footprint chart from tradinglight.com. All right. Okay, let me expand it a little so that it can be visible now. All right. So, okay. Now at the bottom of each footprint chart is supposed to be something called delta. Yeah, right here. There's supposed to be something called delta. Well, I don't know why it is not positioned at the bottom here. It is actually placed here. Okay, it is placed up here I'm using trading light, like I said, for this video, but for some reason I've tried the settings to place it under the chart. Is obviously not working. So if you are using other platforms, you may normally find the delta under the chart here, you know, but trading light is placing theirs here. Okay. Anyways, okay, delta here, that's the delta. Delta is basically the difference between the buy and the sell orders. Okay. The buy orders are added together at the end of each time frame. So also are the sell orders. And the difference between the two is what makes up the delta. So a positive delta usually means that there were more aggressive buys, and a negative delta means that aggressive sells were more and sellers are beginning to gain upper hand. So if you take a look at this is a chart of Ethereum USD. Okay, once you hover your mouse around here, like this long candle, you can see the delta is plus 33.06. All right, but the next candle is a bear candle, and you can see that this red candle right here, the delta is actually minus 20.84. Okay, and the next candle shows the same minus 6.58. So that's basically how it works. The buy market order and the sell market order are summed up and added up, and that's how they get the delta. The delta can actually be an indication to tell you which direction price is going. But now, please, I would like to remind you that, hold on, I would like to remind you once again that footprint chart and order flow trading in general is not the holy grail in trading. You know, there is no holy grail in trading. What we have are tools which provide us with clues as to where the control of the market is between the buyers and the sellers. So these are just clues. It is our jobs as traders to use the information to make good trading decisions. Now, the reason why I say this is that you cannot just look at delta and then say, oh, that's a positive delta, surely buyers are in control. That's a negative delta, is a seller's market. No, you cannot just do that. You have to use order flow trading as only a final confirmation of volume, you know, to back up a strategy that you are already using. Because sometimes even a positive delta can still not confirm that buyers are in control. Okay, so please make sure to have other strategies in place. Do not neglect market structure, chart patterns, support and resistance. Those should come first in your analysis. Order flow and footprint charts should only be used to avoid things like fake outs. You use it to avoid fake out by confirming buying and selling interest in the market. Now, here's how I use the footprint chart. I don't just open a trading platform and then head over to the footprint chart. No. What I like to do is that I will make my setting using candlestick chart first. I like to pay close attention to candlestick chart patterns like ascending triangles, descending triangles, rising wedges, falling wedges, head and shoulders, stuff like that. And after I am done with that, I will also look into the prevailing market structures when I am setting up my trades. I still manually draw my trend lines and also my support and resistance. So I will only switch over this to the footprint chart only when price is approaching my point of interest. You know, no, for example, if price is approaching a demand zone, like this demand zone here. Okay. If price is coming from that direction and approaching this demand zone, now assuming that I've done my candlestick analysis and then price gets closer and closer to this level, okay, I would first of all like to know the amount of orders that are within this zone. That's when I will switch over to the full print chart. Because knowing the wave of orders there will let you know how the market is going to react when price hits this level. Okay. So if you are aware of the volume of orders here, that's when you know how the market is going to react within that zone. Okay. So now, once price gets to this level, you'll be able to get a clearer picture. Are the sellers in control or are the buyers stepping in aggressively? And you can only be able to do that if you are using tools like footprint chart. So if the sell orders start to fade while the buy orders are increasing, that could be a sign that support might not hold and we may likely get a reversal. But if the delta continues to get thinner and thinner, or if they continue to be negative, that could be a major clue that buy volume is weak and that price may actually break support and continue to head downwards.
Now, you can also use the footprint chart in combination with the volume profile that we talked about earlier. And as a matter of fact, I believe some platforms like TradingView or Sierra, TradingView and Sierra, I believe, actually use that as their default setting. You can please go and check it out for yourself. Those are amazing tools for trading. Now, I know I've said this before, guys. Please, I know I've said it before. I still need to say it again. The footprint is not some magic tool that is going to make you rich overnight. As a matter of fact, trading in general is not going to make you rich overnight. And the reason is very simple. The reason is that trading in itself is not get rich quick scheme. Okay, it takes a process, and the footprint charts is just one puzzle of the whole process. You still need to understand things like chart patterns, market cycle, key levels, support and resistance. Only then can you use footprint charts at a confirmation of buying or selling interest at a level that you are doing your setup. Now, if you use them in such a manner, they will give you the extra edge and confidence that you need in making your trading decisions. So that is it, guys. Thank you very much for sticking around today. I do hope we learned a thing or two. Now, please, if you have any questions, observations, please do let me know in the comment section down below, and I will make sure to get back to you as soon as possible. So once again, bye bye, and see you in the next video. Thank you.